Welcome to CMA USA Exam Coach. In this episode, we are diving into market ratios, an important group of financial metrics used by investors and analysts to evaluate a company's market performance and investment potential. So, what exactly are market ratios? Market ratios provide insight into how a company is perceived by the stock market based on its stock price, earnings, dividends, and book value. These ratios help stakeholders answer key questions like, is the stock overvalued or undervalued? How much return can I expect as a shareholder? How does this company compare to others in the same industry? These ratios are especially important for investors and financial analysts because they focus on market-based information rather than just internal financial performance. In this session, we'll go through the most important market ratios and EPS one by one. These include earnings per share, or EPS, which tells us how much profit the company is making per common share. Diluted EPS that adjusts basic EPS to include the effect of potential shares from options, convertible securities, and so on. Dividend payout ratio, which tells us how much of the earnings are paid to shareholders as dividends. Price to earnings ratio, or PE ratio, a valuation tool that shows how much investors are willing to pay for $1 of earnings. Price to EBITDA ratio, which compares the stock price to the company's operating cash flow. Dividend yield, this tells us how much dividend income we get for each dollar invested in the stock. Earnings yield, this is the inverse of the PE ratio and shows the return on investment from earnings. Book value per share helps us understand the net asset value of the company per share. Market to book ratio. This compares the market value with book value to gauge market sentiment. Shareholders' return, the overall return received by shareholders, combining dividends and capital gains. We'll explain each of these ratios with definitions, formulas, and examples to help you prepare effectively for your CMA exams. Now, let's get started with EPS. EPS stands for earnings per share. It tells us how much profit is available to each common shareholder if the company were to distribute all of its net income. It simply tells you how much of the company's profit is allocated to each individual share. In other words, if you own just one share in the company, EPS shows how much profit is yours from the total net income. It's like asking, out of all the money the company made, after paying its expenses, taxes, and interest, how much is my share if I hold just one stock? This helps investors understand how profitable the company is on a per-share basis and whether it's generating good returns for its shareholders. Let's understand EPS with a simple example. Imagine a company has a net income of $500,000 for the year. This is the profit the company made after all expenses, taxes, and interest. Now, let's say the company has 100,000 outstanding shares. These are the shares currently held by shareholders. To find the earnings per share, we use this simple formula. EPS equals to net income divided by number of shares. So in this case, EPS equals 500,000 divided by 100, 000 equals $5 per share. This means for every share you own in this company, your portion of the profit is $5. EPS helps investors know how much they're earning on each share they hold. It's a key measure of a company's profitability from a shareholder's point of view. So now we understand that EPS is calculated by dividing net income by the number of outstanding shares. But there's an important adjustment we need to make. If a company has issued preferred shares, it must pay dividends to those preferred shareholders first. These preferred dividends are paid out of the net income, which means the amount remaining after this payment belongs to the common equity shareholders. So, in our EPS formula, we don't take the full net income, we subtract the preferred dividends from it. Therefore, the revised income becomes net income minus preferred dividends. Just like how we adjust the numerator by subtracting preferred dividends, we also need to be careful with the denominator, the number of shares. The number of shares can change throughout the year. A company may issue additional shares or buy back its own shares as treasury stock. These actions affect the actual number of shares available in the market during the year. So instead of using just the ending or beginning share count, we use the weighted average number of common shares outstanding. This approach gives us a fair and accurate measure of how much each share truly earned over the period. So, to summarize, the correct EPS formula is EPS equals to net income minus preferred dividends divided by weighted average number of common shares outstanding. We'll walk through this in detail with an example to make it even clearer. Now, let's understand how to calculate the weighted average number of common shares outstanding, or 1CSO. This is very important for an accurate EPS calculation, especially when the number of shares has changed during the year. Let's go through a simple example step by step. The company starts the year with 100,000 shares on January 1st. On March 1st, 2024, it issues 20,000 new shares. These additional shares will count from March till the end of the year. That's 10 months, or 10 out of 12 months. On June 30th, 2024, the company buys back 10,000 shares as treasury stock. These shares are no longer outstanding, so we'll deduct them from July to December, that's 6 months. Again, on September 30th, 2024, another 5,000 shares are bought back as treasury stock. These will be subtracted for 3 months, October, November, and December. Finally, on November 30th, 2024, the company issues 15,000 new shares, which will be considered for just 1 month, December only. Now, we multiply each transaction by the fraction of the year it was effective and calculate the weighted total. This will give us the weighted average number of shares outstanding for the year. Now, let's understand the weighted average number of common shares outstanding, or 1CSO, in a more simplified way. We'll start with the opening balance of shares and then adjust only for the changes in share count during the year, based on the number of months they were effective. Opening balance of shares on January 1st is 100,000 shares. This stays for the full year, so we keep the entire 100,000 shares in our base. Now let's look at the changes. On March 1st, 2024, the company issued 20,000 new shares. These shares were outstanding for 10 months out of the year. So we calculate. 20,000 multiplied 10 divided by 12 equals 16,667. On June 30th, 2024, the company bought back 10,000 shares as treasury stock. These were removed from circulation for the remaining 6 months. So, 10,000 multiplied 6 divided by 12 equals 5,000. On September 30th, 2024, the company bought back another 5,000 shares. These were held for 3 months. So, 5,000 multiplied 3 divided by 12 equals 1,250. On November 30th, 2024, the company issued 15,000 new shares, which were outstanding for just 1 month. So, 15,000 multiply 1 divided by 12 equals 1,250. Now let's add everything. Opening shares, 100,000. Add 16,667. Subtract 5,000. Subtract 1,250. Add 1,250. Equals 111,667 shares. So, the weighted average number of common shares outstanding for the year is 111,667. This is the number we'll use in the denominator for calculating EPS, as it gives a fair view of how many shares were effectively in the market during the year. Now that we've calculated the weighted average number of common shares outstanding, 1CSO, let's move ahead and calculate the earnings per share, EPS. Let's say the company's net income for the year is $600,000. Out of this, the company needs to pay a preferred dividend of $50,000 to its preferred shareholders. That means the amount available to common shareholders is $600,000 minus $50,000 equals $550,000. We've already calculated the WONCSO as 111,667 shares. So now let's apply the EPS formula. EPS equals net income minus preferred dividend divided by weighted average number of common shares outstanding. Substitute the values. EPS equals 550,000 divided by 111,667 equal sign $4.93. This means the earnings per share is $4.93, which represents the amount of profit attributed to each outstanding common share. This is a key indicator for shareholders, as it tells them how much of the company's profit is allocated to each share they hold. Next, we're discussing diluted earnings per share, or DEPS. In this segment, we'll break down what diluted EPS is, how to calculate it, and why it's crucial for investors. What is diluted EPS? Diluted EPS is a more cautious measure of earnings per share. Unlike basic EPS, which only considers the current number of outstanding shares, diluted EPS takes into account potential dilution from securities that could convert into common shares. These securities include things like stock options, convertible bonds, and warrants. Why does this matter? When these securities convert to shares, the total number of shares increases. That means the same profit is now spread over more shares, which can reduce the earnings per share. So, diluted EPS helps us understand what the earnings per share might look like if all potential dilutive securities were converted. Before we continue with diluted EPS, let's take a step back and understand basic EPS more clearly with a simple example. Imagine a company has 6 shareholders. The company earns a net income of $120,000. To calculate the earnings per share, we divide the net income by the number of shareholders. So, EPS equals 120,000 divided by 6, which gives us 20,000 per shareholder. Now, let's say the number of shareholders increases to 12. But the net income stays the same, still 120,000. Now, EPS becomes 120,000 divided by 12, which gives us 10,000 per shareholder. So what just happened? The earnings per share got reduced from 20,000 to 10,000. This is a simple way to understand dilution. When the number of shareholders or shares increases, the earnings per share goes down. We say the ownership has been diluted. We'll explore the different types of dilution and what causes it. Now, let's discuss dilution in more detail. When we talk about diluted earnings per share, we're referring to how potential dilution affects the number of shares outstanding. But what exactly causes dilution? Let's break down the key items that contribute to dilution. Items that cause dilution: stock options and warrants. Stock options are contracts that allow employees, executives, or other stakeholders to purchase shares of the company at a fixed price, usually lower than the current market price. When employees exercise their stock options, new shares are issued, increasing the total number of outstanding shares. Warrants work similarly to stock options, but are typically issued to investors or lenders as part of a financing deal. Like stock options, when warrants are exercised, they lead to an increase in shares outstanding. Convertible bonds. Convertible bonds are a type of debt that can be converted into a predetermined number of shares of common stock. When a company issues convertible bonds, it may eventually need to issue more shares if the bondholders decide to convert their bonds into equity. This can dilute the earnings per share because more shares are added to the pool. Convertible preferred stock. Convertible preferred stock can also be converted into common stock at the shareholder's option. Similar to convertible bonds, when preferred stockholders convert their shares into common stock, the total number of shares outstanding increases, which could impact the company's diluted EPS. Restricted stock units (RSUs). RSUs are a form of equity compensation given to employees. These are shares that are granted but not vested until certain conditions are met, such as time-based or performance-based requirements. Once the RSUs vest, the employee receives the shares, which adds to the overall share count and contributes to dilution. Employee Stock Purchase Plans (ESPPs). ESPPs allow employees to buy company stock, typically at a discount. While not always dilutive by themselves, when employees exercise their rights to purchase the stock, new shares are often issued, leading to dilution. Rights offering. In a rights offering, a company offers existing shareholders the right to purchase additional shares at a discounted price. If shareholders exercise these rights, new shares are issued, which could dilute the earnings per share of existing shareholders. How dilution affects EPS. When any of these dilutive securities are converted into common stock, they increase the total number of shares outstanding, thereby reducing the earnings per share for existing shareholders. The effect can be significant, especially for companies with a large number of stock options, convertible bonds, or RSUs. This is why it's crucial to calculate diluted EPS rather than just relying on basic EPS, especially when these dilutive items are present. Let's go through an example to see how dilution affects earnings per share. Imagine a company with 500,000 shares outstanding. The company earns a net income of $1 million. To calculate the basic earnings per share, we divide 1 million by 500,000. This gives us a basic EPS of $2. Now, suppose the company has 100,000 stock options and 50,000 convertible bonds that can be converted into common stock. If all of these are exercised or converted, the total number of shares increases to 650,000. Now, we recalculate EPS using the same net income of $1 million, but divide it by 650,000 shares. This gives us a diluted EPS of $1.54. As we can see, the diluted EPS is lower than the basic EPS because the total number of shares increased due to the potential dilution from stock options and convertible bonds. Let's discuss market ratios now. These ratios help investors assess how a company's stock is performing in the market relative to its earnings and dividends. We'll begin with one of the most popular market ratios, the dividend payout ratio. So, what is the dividend payout ratio? It tells us how much of the company's net income is being paid out to shareholders in the form of dividends. In other words, it measures the portion of earnings that is distributed rather than retained in the business. The formula is simple. Dividend payout ratio equals dividends declared divided by net income. Here's the equation again. Dividend payout ratio equals dividends per share divided by earnings per share. Both formulas give the same result depending on what data you have available. Why is this ratio important? Because it tells investors whether the company is rewarding its shareholders regularly or whether it's retaining most of the earnings for future growth. A higher payout ratio may be attractive to income-focused investors, while a lower ratio might suggest the company is reinvesting heavily into expansion. Next, let's talk about one of the most widely used market ratios, the price-to-earnings ratio, or simply the PE ratio. The PE ratio tells us how much investors are willing to pay for each dollar of a company's earnings. It helps evaluate whether a stock is overvalued or undervalued based on its earnings. Here's the formula. PE ratio equals market price per share divided by earnings per share. Let's take a simple example. Suppose the market price of a company's share is $50 and its earnings per share is $5. Now, applying the formula, 50 divided by 5 equals 10. So the PE ratio is 10. What does this mean? It means that investors are willing to pay 10 times the company's earnings for one share. In other words, they are paying $10 for every $1 of current earnings. Why would they do that? Because they expect the company to grow in the future. A higher PE ratio usually indicates that investors are optimistic about the company's future earnings potential. So, even though the current EPS is just $5, the market is valuing the share at $50. This shows that price in the market is not only based on current earnings, but also on expectations of future growth. That's why the PE ratio is such an important indicator of investor confidence and market sentiment. Now, let's look at the price to EBITDA per share ratio. This ratio compares the market price of a single common share to the company's EBITDA per share. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. It represents the company's operating performance without the impact of financing and accounting decisions. So, what does this ratio tell us? It shows how much investors are willing to pay per share for each dollar of the company's core operating earnings. In simple terms, the higher the ratio, the more investors are paying for each dollar of EBITDA. This usually reflects strong expectations for growth and profitability. Here's the formula. Price to EBITDA per share ratio equals market price per share divided by EBITDA per share. This ratio is useful when comparing companies in capital-intensive industries where depreciation and interest expenses can vary widely. It gives a clearer view of a company's operating strength from the investor's perspective. Next, let's discuss the dividend yield ratio, a key metric for income-focused investors. The dividend yield shows how much a company pays in dividends each year relative to its share price. In simple terms, it tells you what percentage of your investment you get back annually as dividend income. Here's the formula. Dividend yield equals annual dividend per share divided by market price per share. Let's take an example. Suppose a company pays an annual dividend of $4 per share, and the current market price of the share is $80. Using the formula 4 divided by 80, we get 0.05 or 5%. So the dividend yield is 5%. This means if you invest in the share at the current market price, you can expect a 5% return annually through dividends. Why is this important? Because it helps investors compare income potential across different stocks. A higher dividend yield can be attractive for those who want steady income, especially retirees. But it's also important to check if the company can sustain its dividend payments. In summary, the dividend yield ratio is a simple but powerful tool to evaluate the income-generating ability of a stock. Now let's explore the earnings yield ratio. This ratio is the inverse of the price-to-earnings ratio. It shows how much earnings a company generates for every dollar invested in its stock. In simple terms, it tells investors the return they are earning from the company's profits, expressed as a percentage of the market price. Here's the formula. Earnings yield equals earnings per share divided by market price per share. Let's walk through an example. Suppose a company has an earnings per share of $6 and the market price of its stock is $75. Now apply the formula 6 divided by 75 equals 0.08 or 8%. So the earnings yield is 8%. This means that for every dollar an investor pays for the stock, the company is generating 8 cents in earnings. Why is this ratio important? Because it helps compare stock earnings to other investment opportunities, like bonds or savings accounts. Higher earnings yield may suggest a more attractive investment, especially if future growth is uncertain. In summary, the earnings yield ratio is a useful tool to assess whether a stock offers good value relative to its earnings. Now, let's talk about the book value per share, an important ratio that shows the value of a company based on its balance sheet. Book value per share represents the equity value available to common shareholders, divided by the total number of outstanding shares. It tells us what each share would be worth if the company were liquidated today at its recorded book value. Here's the formula. Book value per share equals shareholders' equity minus preferred equity, divided by the number of common shares outstanding. Let's go through an example. Suppose the company has total shareholders' equity of $1 million and preferred equity of $200,000. There are 100,000 common shares outstanding. Using the formula, 1 million minus 200,000 equals 800,000. Then divide that by 100,000 shares. The book value per share is $8. This means if the company were to shut down and sell all its assets at book value, each common shareholder would receive $8 per share. Why is this ratio important? Because it helps investors compare the market price of a stock to its actual accounting value. If the market price is much higher than the book value, investors may be paying for future growth expectations. If the market price is below book value, it might indicate an undervalued stock or deeper problems in the company. So, book value per share is a useful benchmark when analyzing the true worth of a company's stock. Now let's move on to the market-to-book ratio, a key measure of how the market values a company compared to its actual book value. This ratio compares the market price of a company's shares to its book value per share. It helps investors assess whether a stock is undervalued or overvalued. Here's the formula. Market-to-book ratio equals market price per share divided by book value per share. Let's go through a simple example. Suppose the market price of a share is $24 and the book value per share is $8. Using the formula 24 divided by 8, we get a ratio of 3. So the market-to-book ratio is 3. What does this mean? It means the market is valuing the company at 3 times its accounting book value. This usually reflects investor confidence and expectations of strong future performance. However, a very high ratio may also signal overvaluation, while a low ratio might indicate undervaluation or financial trouble. In summary, the market-to-book ratio helps investors understand how the market perceives a company's worth relative to its actual net assets. It's especially useful when comparing companies within the same industry. Now let's discuss the shareholder's return ratio, a comprehensive measure of the total return a shareholder receives from owning a stock. This ratio combines 2 key sources of return, dividends and capital appreciation. In other words, it reflects how much a shareholder earns through both dividend income and the increase in the stock price. Here's the formula. Shareholders' return equals ending. Stock price minus beginning stock price plus dividends per share divided by beginning stock price. Let's break that down. The change in stock price represents capital gain, while the dividend is the income portion. Together, they give us the total return on investment. For example, if a stock was bought at $50 and now it's trading at $60, and the investor also received a dividend of $2, the return would be 60 minus 50 plus 2, that's 12 divided by 50, giving us 0.24 or 24%. So the shareholder has earned a total return of 24% on their investment. Why is this important? Because it gives a complete picture of shareholder value creation. It helps investors evaluate both income and growth potential of a stock, instead of looking at dividends or price appreciation alone. This ratio is widely used by long-term investors to compare the total performance of different stocks. Thank you for watching this video. We hope you now have a clear understanding of the concepts we covered. To reinforce your learning, don't forget to go through the practice questions provided in your support package. The more you practice, the better your understanding will become. And that's the key to exam success. Keep learning, stay consistent, and build your confidence step by step. See you in the next episode.